Hello everyone online. Hello everyone in person. I'm Rebecca Christie, Senior Fellow here at Bruegel. Delighted to welcome you to today's event on the ECB's operational framework and the digital euro. This is your chance to get technical with us and ask all of your questions about how the operational framework is coming along, how it might interact with the digital euro, how the ECB might deal with the stablecoin question given recent developments in the US. These are all things we may cover today. We have until 1:45, so we have an hour and 15 minutes. I encourage you in the room and online to ask questions. And we have a Slido, which is #DigitalEuro. So our panelists today are pretty fantastic. We have from the ECB, from Frankfurt, Imen Ramouni-Rousseau, who runs the ECB's market operations unit and is really just the best possible person we could have to discuss this with us. We have Bruegel's own Francesco Papadia, who had a similar role at the ECB in times past, and then joining us, Professor of Economics from Roma Tre University, Alberto Pozzolo, who has recently edited a journal edition specializing in policy issues around these topics, and so will walk us through some of these things. With that, we will jump right into it. Imen, can you tell us where we stand with the operational framework and where it overlaps with these areas? Thank you.
Thank you very much, Rebecca. So it's a pleasure to be here in Bruegel. It's my first time addressing Bruegel, and also a pleasure to share the stage with Francesco, Alberto, and yourself. Yeah. So I'm going to indeed provide an espresso version of the new ECB operational framework. And tell me, Rebecca, what time I have. Like I have 10 minutes. Yeah, great. And then I'll say at the end a word on how it overlaps with the digital euro. But of course, the digital euro is a whole different topic, and I'm sure that Alberto and Francesco will say more on this than I will. Yeah. So. What is an operational framework for a central bank? I think it's important to start a little bit big picture. So central banks, as you know, set interest rates for the economy. Yeah, so this is in jargon what we call the stance of monetary policy. These are the decisions that central banks announced. So ECB decision on Thursday, as you know, and then these decisions on rates, and also when central banks use other monetary policy instruments like asset purchases, these get implemented in practice. So that means that this rate, there are operations and a framework around the liquidity in the banking system that will help set short-term interest rates, which are market interest rates, close to the policy target rate, and also as we adjust the policy rate, that these short-term interest rates follow by similar amounts, if you want, or extend the monetary policy decisions. Yeah. So we have recently announced, and that was in March 2024, a new operational framework and changes to the way that we were providing liquidity in the past. It helps to see where we are in terms of the central bank balance sheet as a starting point. Yeah. So as many of you know, as a consequence of reaching the effective lower bound on interest rates, we had from the end of 2014 and especially 15 until recently engaged in large-scale asset purchase programs. As a result, we have injected a lot of liquidity into the banking system, and the level of what we call excess reserves, which is the quantity of reserves above minimum reserve requirements of banks, this level of reserves has increased a lot, yeah, and has peaked in the middle of 2022 around basically 4.8 trillion or something. Since then, we have started to let our monetary policy portfolio redeem, which means that we do not reinvest what comes due, and the central bank balance sheet has started to decrease again. Yeah, and basically what we aim to address with the new framework is to give visibility to markets as to how the transition to a lower level of reserves will take place and what they can expect in terms of satisfying their needs for liquidity in the future. So let me say that we are not alone as a central bank to engage in adjusting these frameworks, because a number of central banks are going through these adjustments in reducing and scaling down their balance sheet, the Fed, the Bank of England, the Bank of Canada, Australia, and so on. And these frameworks really, as we have never been through such a phase of reduction in the balance sheet in the past, and also we've never been in a phase where liquidity regulation has been in place, because before the financial crisis it wasn't. All these frameworks are incorporate an element of learning by doing and adjustment, and a number of central banks have already, announced a number of adjustments. Yeah, so what do we, in broad terms, what do we aim to do in the new framework? We have decided to go for a framework where, instead of determining us at the central bank as a central planner how much reserves the banks want to hold in the future, we will adapt to the demand that banks express for reserves. So we have a weekly liquidity providing operation that operates as a repo, so against collateral. And this is 1 week operation where we will basically satisfy in full the needs of banks for liquidity. Yeah, so banks come to us, they say, I want, 100, and we will provide 100 at fixed rate, full allotment, and also against broad collateral, which includes not only government bonds, but things like high quality loans. So with this framework, we really satisfy the demand for banks for liquidity, but at the same time, we don't satiate it as other central banks like the Federal Reserve do, because in the Federal Reserve, they determine themselves the level of reserves, and they leave a little bit of buffer above what is strictly needed. However, we still think that our system will provide sufficient reserves, which is the condition for money markets to operate. Yeah. In this new operational framework, we will also provide the liquidity at conditions, meaning pricing, in particular of these operations, that will allow at the same time to reach our objective of controlling interest rates in line with the policy rate, so contain the volatility in money market rates, and allow room for money market activity for banks to be able to exchange reserves between themselves, between banks that are short of reserves, banks that are in excess, before they come to the central bank to ask for their remaining needs. Yeah, and the kind of spread that we allow between the lending operation and the deposit rate is 15 basis points, which is a relatively narrow spread to achieve the objectives I just mentioned. Yeah. And let me also mention that we expect that the liquidity will continue to decrease. Yeah, our portfolios are redeeming 500 billion euros per year, and at some point it means that. So at the moment, the banks are coming to this repo operation for very small amount, which is very consistent with the fact that they still have a lot of liquidity. But as the liquidity goes down, we expect them to come more and more. And at some point, their recourse in aggregate will offset the amount of redemptions on our portfolio, and so at that moment, which is an inflection point, the balance sheet will start to grow again, okay? And after this moment where the balance sheet will start to grow again, we will introduce structural operations, so basically satisfy banks' needs on a more longer term basis to allow them to plan for their funding. And we will have a long-term lending operation and also a portfolio of securities to provide liquidity. On the digital euro and the link, it's actually not something that is out of the ordinary of monetary policy implementation, because we already have banknotes that are affecting banking system liquidity, yeah? And whenever the demand for banknotes increases, because banknotes sit on our balance sheet, the liquidity in the banking system decreases, okay? And so it means that all things equal, we might have to provide more liquidity through our operations. Now, with the digital euro being implemented, it means that first of all, the question is to what extent it will substitute for bank loan demand, you know, this new retail digital form of money. To the extent that you have substitution and not more than substitution, we will in net not have an impact on liquidity conditions, but to the extent that the demand for digital euro surpasses the demand for banknotes, banks will need to get this liquidity. And this is where our framework, which is really this framework that accommodates banks' needs and provide liquidity as much as they need, will actually help to also maintain stable liquidity conditions as the digital euro establishes itself.
Thanks very much. Francesco.
Yeah, well, thank you very much, Iman. And I will interpret my role as asking you questions. I have many, but I will choose the ones that I think are most relevant. The first one is about the non-bank financial institutions. If you look, I mean, you refer to the fact that other central banks are changing the way of implementing monetary policy. And in many of these cases, this central bank do allow non-bank financial institutions to have access to their operations, mostly on the deposit side, but also on the lending side. I mean, the Bank of England, the Sveriges Riksbank, the Federal Reserve, in different ways. But they've broken the taboo that the central bank can only work with banks. The taboo still seems to prevail in Frankfurt. So, and I haven't read much about a discussion when you published your review of the operational framework. I just saw a statement. The Governing Council doesn't think appropriate to move away from enlarge to non-banks. So whatever you can tell us about this issue. Then another question that I would have, and here I stand ready to be corrected by you, but it seems to me that the dichotomy between hawks and doves extends to the issue of the operational framework. In what sense? In the sense that hawks are in favor of less liquidity, in favor of liquidity provided on demand, instead of being provided on the initiative of the central bank, so borrowed, non-borrowed reserves. Now, I'm asking you whether you or the ECB has any view that indeed the operational framework has a bearing on the stance of monetary policy. My view is that it has not. That you can implement whatever monetary policy, whatever stance of monetary policy, you can be as tight as you wish or as easy as you wish with whatever operational framework. But I mean, there is this still lingering doubt, and I mean, if you just look at who is in favor of this or who is in favor of that, you tend to find that, traditional hawks tend to prefer less liquidity given on demand, and traditional those rather prefer the ECB to go around and providing liquidity according to its own decision. Another point, which is a bit more mundane, but what is your sense of the preparation of banks to navigate the new system? Of course, one puzzling element, at least puzzling to me, is that you felt the need to come up with a new operational framework when there was no need to do that, because in any case, liquidity is so abundant that your decision has made no impact in practice. Maybe it will make an impact maybe to end of 2006. I don't know exactly when, but for the time being, you have changed your operational framework, and basically nothing has changed. Now, are banks instead ready for when the change will take place? You talk about the inflection point, when the balance sheet will start growing again, when there could be a sort of a risk, if you want to see that way, of the market rate moving away from the deposit facility rate. So is your sense, are your contacts with banks reassuring you, yes, we are ready, we will do whatever is needed, don't worry. You refer briefly to central bank digital currency, and I still remain to be convinced that this is not an issue for liquidity management. Of course, you refer to banknotes. And in the past, when reserves were scarce, estimating the demand for banknotes was one important component of estimating the so-called autonomous factors outside of the control of the central bank that impact on liquidity. But at that time, there were very long time series, a lot of work was done, so it was relatively easy to forecast what would be the progress of banknotes going forward. Now CBDC, nobody knows. Will there be demand for CBDC? What will impact the demand? And in particular, can one foresee a situation where there is little demand? Because I don't think that whether you have seen crowds around the ECB building with placard asking for CBDC, but my sense is that the private sector is very happy with Visa or MasterCard. And so maybe there will be not much demand, except when a crisis comes. When a crisis comes, central bank liabilities become very, very interesting indeed. And so you could have a situation where normally you have very little demand for CBDC. And then during a crisis, this goes up greatly. And my question is, would the operational framework be able to deal with this phenomenon? I see that Rebecca is raising a microphone to her mouth, which I understand meaning that I'm done. I would have many other questions to ask, but I think that's a good start.
We will come back, because just your last question, you know, there are different ways of looking at the digital euro as a means of payment, as a store of value, as a connection to the distributed ledger technology world, separate from how much it's used as a means of payment, and as a perhaps alternative to privately run stablecoins. So these are all things that we will come back to. Alberto, you have been looking at what a digital euro can do and what it's for. Can you talk to us about that and all your things that you prepared? You have your own microphone.
So thank you, and thank you also for inviting me here. Yeah, the thing is that I have the impression that when we talk about central bank digital currencies, sometimes we are reasoning very much thinking about the situation now and not thinking about what could be relatively soon. So the problem, the way I see it, the way we see it actually in this issue that we wrote on central bank digital currencies, is whether there can be substitution between public money and private money. Indeed, we know that we are using private money most of the time. It's bank money, and its supply is very much under control of the central bank. Indirectly, through the operational framework, through fixing the interest rates, but in the end, banks cannot increase the amount of money, of private money that they produce without control. Is this the case the moment in which we introduce a stable coin, for example, denominated in euro? And this seems to be something that can happen relatively soon. From a technological perspective, we're probably there. I mean, it's not difficult, say, for a large retailer on the internet. Think about Amazon that decides to issue a stable coin denominated in euro, and probably giving also some benefits if you use it to pay in Amazon. Well, at that point, the idea is that it is possible that many people start using that stable coin. Network economies in payments are pervasive, so eventually we may get into the situation where others are actually accepting this stable coin. But it is stable. I mean, what really matters is what is the backing of this stable coin. Does it work? Well, in the past, we have seen that it doesn't work that much. We have already seen this during the free banking era in the United States, and there were discrepancies in the evaluation of banknotes issued by different banks that, in theory, should have had the same value, but they didn't. Even stable coins today, they're very close to par, but sometimes they oscillate around par. When there was the Terra problem, some stable coins actually lost a bit. In the end, our view is that what really matters is to control the amount of stable coins that are issued. But if we get used to paying with this stable coin issued by Amazon, eventually it may even become a unit of account. It doesn't seem so far-fetched thinking about this. I mean, it's already happened in the past. It happens in some countries. And the idea at that point is that you can either try to regulate it, as we do regulate private money issued by banks, but that can be very complicated. I mean, some of these stable coins are issued outside the reach of domestic regulation. Another thing that you can try to do is actually to require that there is a one-to-one matching with a very liquid and safe asset. But at that point, think that asset is short-term government bonds. Then in the end, the total amount of stable coins that can be issued is capped by the amount of government bonds that are around. So we are back to a situation where there is no central bank, independent central bank controlling money supply, and it is something that is more or less controlled by the government. I'm not sure that this is a very good solution. So this solution, from our perspective, is actually to try to introduce something that plays against the stable coin exactly at the same level as the stable coins actually play. So introduce a central bank digital currency that, of course, needs to be as user-friendly and convenient as a stable coin, and that's probably the real challenge. From the theoretical perspective, we can describe this as a situation in which there is some kind of mixed oligopoly. It's a literature in industrial organization that is not very much in fashion anymore, but the idea is that you have players that are private players, profit-seeking, but at the same time you have a public player that has a different objective that in this case, for example, could be controlling the possibility that a different unit of account emerges, and the two players can compete in the market, and eventually you can find a good solution.
Thank you so much for that. It's super helpful for thinking through these things. Imen, before we go back to you to answer Francesco's pile of questions, I want to add a little bit extra concept that it would certainly help me if you would go through, and would help at least one question online. We had a question online about, can the ECB lend money to the banks without collateral, or does this have to be collateralized, and is it therefore more expensive than deposits for the banks? And my related question is, as you go through this, can you remind us why the ECB's balance sheet is different from the Fed's balance sheet? Because I understand, and I may not have this right, that the ECB, it's a little bit separate what happens to the balance sheet versus what happens in monetary policy. Whereas with the Fed, there's really a very direct link. The balance sheet and monetary policy are kind of the same thing. The repos are how they do the monetary policy. And yeah, I see you making a face, and I would like you to explain that better. Thank you.
Thanks, Francesco, for your questions, and I mean, always very insightful, of course, and Rebecca. So I'll start with this question of Fed versus ECB. I think that the balance sheet of a central bank, at the end of the day, they are very similar. Yeah. So on the liability side, you have banknotes and bank reserves, bank deposits at the central bank, and on the asset side, you have generally foreign exchange reserves and gold. You have and then the monetary policy part of the balance sheet, which is partly repo operations, so banks borrowing from the central banks, and then a portfolio of monetary policy securities. So both central banks have, a balance sheet that is structured pretty much the same. But the difference is that the tools that we use to implement monetary policy are used to a different extent, okay? So the Fed, maybe this is what you had in mind. They have this tradition that their main channel to provide liquidity is through purchases of government bonds, also for liquidity purposes. So it's not QE. QE stopped, as you know, at the Fed, and now they are going into quantitative tightening, which is the same as us, which is dialing down the Fed balance sheet. But every day or week, they basically buy treasury securities to provide liquidity to the market. Yeah, we have the system where, as I said, the marginal unit of reserves today, so what the banks need additionally every week, is provided through repo operation. The Fed also has repo operation. I mean, this is a relatively new feature. They introduced it just after the pandemic. It's called the Standing Repo Facility, the SRF. But this facility is never used. I mean, you would struggle to find a moment where a bank has access to this facility, and this is because the Fed has decided to act mainly with the other tool. In our case, I mean, as I said, it's small amounts at the moment, but you always find some 40 banks, mostly small, that have access the repo operation. I don't know if that answers your question.
It does help, and I appreciate going back, because the Fed, for those of you who haven't been watching this forever, the Fed didn't used to actually announce its interest rate decisions. People used to just have to look at its bond purchases or sales and figure out what the rate was. And they only started doing press conferences fairly late in the game, whereas the ECB has always been very transparent. And also the ECB has many national bond securities that make up its portfolio, whereas the Fed just has one. And that, I think, also changes how one does the balance sheet. And for me anyway, when I try and think through Francesco's excellent raft of technical questions, it helps me to remember how much of that is managed at the same time as monetary policy and how much of it is managed sort of alongside but not directly, if that makes any sense. And so I appreciate your walking us through that.
Yeah. I mean, this will go back to Francesco's question on the is there a relationship with the stance of monetary policy or not? So maybe I address this anonymous question on that because it's easy. I mean, no, the ECB cannot lend money to the banks without collateral. We need adequate collateral, And I think this is the case for most central banks, except, one temporary example I have in mind recently after SVB. I won't elaborate on that. But it doesn't mean that we are constrained in the amount of money we can lend to banks. We are only constrained by the total amount of collateral available in banks' balance sheet. And in the ECB, we have from the very beginning of monetary union made sure that a very substantial part of banks' balance sheet can constitute adequate collateral. And how did we do that? We have not only marketable securities, both sovereign and private, of good quality that are collateral, but also, as I said, bank loans of sufficient credit quality. We have a whole system for actually assessing the quality of bank loans. We have internal rating systems and so on. So we have this broad collateral that basically make liquidity provision very elastic today. So now let me know if I go through Francesco's question, and of course
maybe pick, I would say, 5 to 8 minutes worth of Francesco's questions to answer, because if you go through them all, we'll be here till dinner time.
No, I'll try to be very brief. So non-banks, I confirm the fact that at the moment, and that the review indeed did not revisit the question of the range of counterparties. At the same time, non-bank financial institutions are a growing part of the financial system. The ECB basically, also the reason why we still operate through banks is that the euro area is a bank-based system, differently from the US and to some extent the UK. And also we have found out, and there are working papers on that during the pandemic, the liquidity that we provided through asset purchases has actually reached the non-bank sector through the banks. I just make myself, clear. One very good example was the fact that we have decided to purchase commercial paper, and commercial paper was held by money market funds at the time who were experiencing some outflows. But what the money market funds did is that, they sold this commercial paper to the banks, and the banks basically, sold it to us. So that's a kind of back-to-back understanding that this works, Now I think the Bank of England has... For me, the Bank of England is probably the most interesting examples of both the way and the rationale for having non-banks as part of the toolkit for central banks. So what the Bank of England said is that they have a contingent facility for non-banks. So it's not open all the time. It's only open, and they made it very clear, where some instability in the non-bank sector would put at risk the functioning of the main market for transmission of monetary policy, which is the sovereign bond market. That's the rationale. Outside of these cases, and they determine it, the facility is not open. And they have also circumscribed the type of non-banks at the moment to insurance companies and pension funds, which are the type which is most closely regulated and supervised relative to, hedge funds, for example. Now, Francesco, on your question of what do the views on the operational framework have to do with the stance of monetary policy? I mean, my personal view is that it's the same as yours, is that this is separate. So the stance is set by interest rates, and the operational framework is there to implement the stance. And as a matter of fact, you see in the announcement of the framework, even though it's implicit, that there was a sentence at the end saying that the framework for the stance of monetary policy is set by the strategy review, and this is a review different from the operational framework review that is actually also going on at the moment at the ECB. And let me also say that I had a look at the speeches of different central banks and on the framework, and they basically all mentioned that the framework are operational elements that do not relate to the stance of monetary policy. So I think there is a clear-cut distinction there, and I would think that this is the consensus view. Preparedness of banks, excellent question. So our intention with going early rather than late with an announcement on the framework was not to think that we're going to face some accident tomorrow, was exactly to provide banks with time to prepare for a world where liquidity would be scarcer. And the reason for that is that, since the financial crisis, banks' liquidity management has changed a lot, And when they were navigating the period of abandoned reserves, they had to do, honestly, very little on liquidity management. Optimizing this was not a constraint. But today, and with the lead time that we are providing to them, and indeed, I mean, you mentioned, 20 at the end of 26, 27, maybe 28. We don't know where the situation will become more difficult to manage. At that point in time, they would have had time to not only think about how to optimize, but also how to manage at the same time their level of reserves and their new liquidity ratio. So the liquidity coverage ratio, the net stable funding ratio, which of course are very much linked to the level of reserves as well, because the reserves are a component of these ratios. So we've been putting this time to also good use for public communication. There's been a joint communication from the banking supervision part of the ECB and the central banking part in the form of a joint blog post by Claudio Buch and Isabel Schnabel recently, really reaffirming that the supervisory part will consider the recourse to our repo operation that I just mentioned, which is the main vehicle for providing liquidity as business as usual, no questions asked operation for banks. And we think that this will help to reduce any apprehension of banks to access this operation. Finally, on CBDC, I think excellent points made also by Alberto and Francesco. The design of the digital euro, I think, matters a great deal. Also for this question of what happens in a flight to safety episode, because if you put, and that's the intention, holding limits around the digital euro, you basically reduce the potential for the kind of transfers from bank deposit or outflows from bank deposit, and that's also a way to minimize the impact on monetary policy implementation.
Yes, on this last issue, I had a question to you. The holding limits. The holding limits may be important on two dimensions. The elasticity, the speed with which money can be moved from a bank account to a CBDC account, a digital euro account during a crisis is something that we don't know. Probably is something that we eventually will learn. There are many things that one can think. I mean, one thing is that it is much easier than in the past. So you may think, I wait until it's really a problem, or it is so easy that I do the first moment there is a rumor that there is a little problem, maybe not even in my bank, but in other banks you can have some kind of herd behavior and contagion effects, and that's something that we definitely need to learn. But holding limits, I think, have an impact also related to the question that we have here, in the sense that one thing that, taking a broader perspective, one may ask himself is this eventually leading to a situation in which banks don't fund anymore most of their lending through money-like liabilities, so through deposits, and we go to a situation where banks fund themselves using different types of liabilities, which seems to be pretty fine, but, and this is where I stop, this may introduce some problems, because technological improvements make financial assets much more liquid than in the past. And this, in the end, implies that you can have huge swings, huge oscillations in prices, because if people are unhappy with some liabilities and they sell it, you're going to have a drop in prices, and this is going to cause possibly a huge wealth effect, and a wealth effect we have learned during the global financial crisis can be pretty much recessionary, with, in the end, also impacts on inflation. So are the holding limits thought only in terms of the substitution from deposits to central bank digital currency, or also with this longer-term, broader perspective?
So, I mean, frankly, the design and the motivation behind the holding limits is being discussed as we speak. Yeah. So I think this is something that you will have the answer to fully in the near future. But let me react on 2 points. One is, and there I fully agree with you, the speed of outflows out of bank deposits in general. Okay, so it's not only the speed of outflows from private money to public money, but it's also, frankly, the speed of runs between different banks. And that's the big lesson of SVB, okay, that we should all reflect on, which is that with innovation, with digital banking, digital forms of money, we increase the speed of these developments. And the question is, we need tools in order to manage that. Yeah, and my personal view is that you need a combination of supervisory tools, because SVP would not have happened if you had a more diversified deposit base, okay, with more insured deposits, and also less focused on one sector, which was the tech sector. So I think that ensuring a diversified and stable deposit base for banks is part of the solution. And then, as you said, there are also things in the design of these, of some of the tools, and clearly in the digital euro, it's the holding limit that change. Yeah, and then I think you're right that there would be very profound changes in the way that banks fund themselves. Okay, I think where, and again, I want to stress there is that the foundation of getting still a well-functioning banking system and so on will be the soundness of banks. And if there's one thing that in the euro area changed since the sovereign crisis very much, I think, is how sound our banks are perceived to be at the moment. I mean, look, SVB, Credit Suisse, euro area banks were not affected, yeah? And we haven't seen the type of dynamics we've seen elsewhere. And so I think with that certainty, which is ensured by common supervision, these transformations of funding models are probably more sustainable, more resilient than otherwise.
Thank Thanks very much. We will soon go to the floor for questions, so think about your questions. Francesco, have you heard anything go by that you'd like to comment on, or a question you'd like to add or re-up?
No, I have one question for Alberto.
Not use your microphone, please.
So I have one question for Alberto and one for Imen. The question for Alberto is, what are, in his view, the necessary conditions for a stable coin to be stable? And I will give you my interpretation, and then I would like you to tell me whether you agree with that. And my interpretation, what is needed, is that in quality, it's the same things that are needed for a bank to be stable. So I say it in quality, meaning that it's not in quantity the same, but a stable coin to be solid, in my view, needs over-collateralization. And over-collateralization is the same as capital requirement for banks. And the other thing that is needed for a stable coin to be stable is management. So it's not a system that doesn't require management. I think that the easiest comparison between a stable coin is with so-called currency boards. The most important currency board we know of is the Hong Kong currency board, which has been there for, I don't know, decades. And if you look at the experience of the currency board, it's not one that does not require management. The Hong Kong Monetary Authority does manage the link to the dollar. And so my final point on this, a stable coin, in order to be stable, needs capital or over-collateralization, which is the same, and management from the issuer. So this is my question to Alberto. My question to Imen is how did the question of stigma played in the review of the operational framework? For those who do not know the story, I mean, stigma was very strong and is still strong, I think, in the United States, in the sense that banks had a reluctance to go to the window of the central bank to borrow money because that was seen as evidence of weakness. So if you need money from the Fed, means you are in trouble. You don't want to show you're in trouble, you don't go for money from the Fed. And the Fed went to very long tools. It even asked very solid banks to go to the window just to show that that was not a sign of weakness. I'm not sure that they got rid of this stigma. Now, in the European Union, in the euro area rather, stigma has been much less of an issue. Going to the window of the central bank was not seen always as a sign of weakness, but sometimes it was. And sometimes it was during the financial crisis when, why are you borrowing so much from the ECB? Does it mean that you cannot borrow on the market? What is your problem? And to some extent, the supervisors added to this because they looked, why is this bank borrowing so much from the ECB? So stigma was, and still is, a very serious issue in the US. It's not such a serious issue on this side of the Atlantic, but still there must have been a reflection, because now you say mostly banks must come to us and borrow from the window, so you must be convinced that there is no issue of stigma in Europe. So these are my two questions to my co-panelists.
Alberto, what is a stablecoin?
I think you are, more lenient than I would be, in the sense that I fully agree that you need management. and you need over collateralization. I am not 100% sure that that would be enough, because I still fear that eventually the stablecoin is stable referred to something. If that something is not used anymore, it's not the anchor anymore, and the stablecoin becomes the unit of account, that's the tipping point. The moment in which the stablecoin becomes the unit of account, I'm not sure that over collateralization and good management is enough, in the sense that incentives at that point to control prices expressed in something that you issue, would you trust a private money issuer on that? I wouldn't, honestly, and I'm not sure that good management would be enough. If you think of currency boards, I mean, you made a very good example, probably the only one that lasted many, many years, because currency boards in Latin America, they all defaulted sooner or later, and I don't see why it shouldn't happen with a private stablecoin issuer. So in the end, I fully agree that it should be like banks, but entirely like banks. It's something that I keep saying. I mean, lawyers like very much stablecoins and all these things, and I'm in a law department. And every time they say, man, this is private money, it's a good thing, I tend to say, listen, we already have private money. It needs to be very well regulated. We call it bank money, and it's there. It's always been there in the last 100 years. I'm not 100% sure you can go much further than that.
Yeah, it raises a great question of, is a stablecoin just a bank deposit by another name with a less clear deposit insurance backing? But anyway, Ivan, would you like to talk about stigma?
Yeah, and also very interesting point. I mean, you know, the stablecoin is stable only as much as the asset side is stable, and that's a mix of treasury bills and bank deposits. And actually, you know, the case you mentioned of stablecoins that went wrong, I think 2 years ago, was actually that, you know, the bank deposit part was in jeopardy, okay, and then you have a run, yeah. So another way to think about it is a money market fund, yeah, frankly, but an unremunerated money market fund. And we know today, and from you know, hard-learned lessons from the financial crisis, that you need a very sound regulation around money market funds, yeah. On stigma, and very informed question from Francesco. So indeed, I think having an accessible, not stigmatized lending facility is absolutely essential for the operational framework to work. And a number of central banks, not only us, are engaged today in creating the conditions for this to happen. In our case, we are in a better place to start with, as Francesco said, because we always had banks coming to our operation. So we're not in this, you know, discount window kind of mindset that the Fed has, which was, this is for bad banks. And they've been trying to convince banks forever that there are virtuous motives to come to the discount window without much success, although I must say recently the recourse has picked up. So how do we do that? I mean, we do that exactly by engaging with banks and communicating, saying that there will be no negative impact of them accessing our operation. And so this is why the supervisors are so important, because indeed in the past there have been a suspicion that a bank's going to the central bank is a bank that cannot fund itself in the market. Yeah, and that may have been the case to some extent during the sovereign crisis, but honestly, as I said, I think we have changed world entirely thanks to actually effective supervision. And so in the future, you would have banks with a diversified funding mix again, which means that they will go to the market, they will issue, you know, certificate of deposits, bonds, they will engage in the repo market, and they will also recourse to the central bank. And that's just a mechanical reality, because if you take the amount of liquidity in the banking system, it's limited, yeah. So when one bank is in excess, another one is in deficit, but you cannot increase it at will unless you come to the operation. So at some point, of course, banks reach that point at different moments, depending on their business model and so on. So we might see a staggered recourse, but this moment will come for everybody. Let me also mention that it's not only supervisors that we're engaging with, also rating agencies are an important part. S&P has put up a piece actually on the framework to say that they fully now will recognize that recourse to the repo operation of the ECB is a normal course of business, yeah, which I think helps a lot. And finally, it's difficult to understand exactly what creates stigma. Yeah, is it that it's perceived because of communication issues? Is it the pricing? Is it the collateral type, and so on? And so, in terms of pricing, we have also made sure that the way our operation is priced, so 15 basis points to the deposit rate, is actually a narrow spread. Yeah, relatively narrow. To exactly avoid the price stigma that would come with that, and the fact that banks with a different set of collateral, for example, which includes collateral that is not traded in the market, will have, even from a pricing perspective, an interest to come at the operation because they cannot monetize their collateral in the market.
Thank you. Do we have questions on the floor? Yes, I see two, one in the front row and then one halfway back.
Kurt Geisert, I'm one of the guides in the House of European History. I found it interesting that you referred to the Central Bank of the United States, a question which is not directly linked to our topic today. Do you think the president of this central bank will survive?
Sure. And then maybe we can pass it around on cash versus digital cash versus private computer money.
It's an easy one because part of the answer I already mentioned. So if you have an increase of, as you said, digital euro more than we expect. As we had discussed, some think that the demand will be low, others expect the demand could be higher. It's really anybody's guess. We have an embedded tool, and that's my famous liquidity providing operation. Okay, so this is like if you think of it as a kind of automatic stabilizer, yeah, because the banks need liquidity, they come to us, we provide it to them at conditions that are well known, unlimited, and at fixed rate. Yeah, so that would be my answer. I don't know if it answers your question because it may be a little bit more pointed. Your question. Okay, great.
On the issue of different, on how much people like cash against central bank digital currencies, what comes into my mind is that the ECB claims that cash should not disappear. So in the sense, the substitution between cash and central bank digital currency, even from an accounting perspective, is a no issue. So even if different countries use digital euros differently, at first sight it doesn't seem to me to be such a big problem. If I can say something that I shouldn't, because you told me not to mention too much of it, but the first question takes me to something that I had in my notes, and another advantage of having a central bank digital currency is the infrastructure behind. And while I agree that many private players may be happy with Visa and MasterCard, they work well. I mean, I paid my tax, I paid everything with Visa and MasterCard. But if I can elaborate a bit on your question, I wouldn't be happy if eventually the fact that Visa and MasterCard are US corporations could become a tool in this game across the two borders of the Atlantic. So having a European infrastructure and especially a pan-European infrastructure, because we have our own payment systems today, but they're very much segmented. And indeed, some countries are more vulnerable to not have a Visa and MasterCard, and others are less. I mean, France is in a very good position with its own payment system. Italy was, but it's not anymore, unfortunately.
So Francesco mentioned that in his opening set of questions. He mentioned dependence on Visa and MasterCard. And I often think of that as the positive case for digital euro. We'll create this strategic autonomy payment system. But I wanted to ask you, Alberto, and for you and also your collaborators, if you had thought through, could the digital euro be a defensive move just to keep some other stablecoin from trying to take up that space with all of the stablecoin issues that you mentioned earlier?
That we write in our issue on central bank digital currencies is that central bank digital currencies are a tool that addresses many different objectives. And all these objectives could actually be addressed differently. So, for example, the problem of having excessive market power by some corporations like Visa and MasterCard could be dealt with antitrust policies, but in the end, it seems that central bank digital currencies are good because they can address many things at the same time. By the way, there is one thing, there is the elephant in the room, but I'm pretty sure that Iman is not going to talk about this, is not going to answer anything, because I tried in the past with some other people at the ECB to mention the issue of costs, but I've been diverted to different issues. One thing that we may think is what happened in China. I mean, in China, they were really ready to introduce their central bank digital currency, and then eventually they slowed down. So an interpretation that we advance in our issue is that you may want to be ready if something happens to say, listen, you're not going to do it because we can enter the market in this mixed oligopoly way quite aggressively, so there is no point for you to try to scale up too much. This is one possible interpretation. I tend to endorse it, but of course others don't agree.
Iman, no further. Oh, right. This has been amazing. Those of you who, like me, want to go back and listen to some of this stuff at half speed to understand it more fully, the recording will be available on our website, bruegel.org, along with our other writings and speakings on these topics. Incredibly grateful to Imen Ramuni-Rousseau coming to us in person, Alberto Pozzolo traveling to be here, Francesco Papadia coming up with the idea for this panel and being on it so wonderfully, and all of you for coming. Thank you very much. Have a great day.